Picking an investment. How to properly analyze a stock. Deciding how to invest is a lot like shopping for a car, but a lot more significant. You gotta first understand your personal needs and style, and then consider various models, comparing choices based on their price and potential performance. Investment decisions deserve a similar but even more robust analysis. For many, evaluating investments may not feel as natural as shopping on a car lot, especially if you are doing it for the first time. Watch this video to learn the basics so you can figure out what to look for and what to potentially avoid. Welcome back, folks, to another edition of Sweetie Kiwi. How are you doing today? I hope you are doing fantastic. I'm doing marvelous if you were to ask me. If you are doing as terrific as I am, go grab a cup of coffee or tea or vodka and let's roll. Today I want to talk to you about how to properly analyze a stock. And I'm going to quickly just go into the nitty-gritty here. Number one, go in with a plan. Your plan should cover four essential elements: your lifestyle, your investment goals, your financial situation, and your aspirations. Lifestyle, investment goal, financial situation, and aspiration. Your LIFA. Not your life, but your LIFA. LIFA. Your plans will inform how long you want to keep in investments. And it's very important to think about your financial situation, because if you are not financially secure, if you need money, you will not be able to put a lot of cash into a stock. And you got to think about whether you are a long-term or a short-term investor. Because if you're a long-term investor, you got to have money that you can afford to lose. Same thing goes for a short-term, but the short-term, the money should be even lower, because you might need some cash to do stuff in the short term. Let's say you need to buy a home, you need to take care of a child's education, caring for parents, or retirement. Then things happen, and God forbid something happens and you have to pay for healthcare costs. That's kind of important to think about. So think about your life, go with the plan, and stick to the plan. The second element is, before you pick any stock, before you select any stock, you need to know the key criteria. I'm going to give you two first. There is size and there is sector. When it comes to size, very simple. Experts call it market capitalization. It's very simple. You take the price of one share, and you multiply that by the number of shares available on the market. It's called outstanding shares, right? So let's say you have a company whose share price is $100, and that company has 10 million shares outstanding. In that case, the market cap of this company is 1 billion. That is $100 times 10 million. That's 1 billion. So you have, if a company's market cap is between 300 million and 2 billion, the experts call that company a small cap company. If the market cap is between 2 billion and 10 billion, they call it mid cap. And if it's above 10 billion, they call it large cap. So a company like Facebook or Amazon or Tesla is a large cap. So that's for the size. And then you have the sector. You have, in general, 11 sectors in the market. And this is there is an organization called the Global Industry Classification Standards Institute. Actually, this is a standard, and what they come up with the 11 sectors. So you want to make sure that you don't invest in the same sector. So before you pick a stock, take a look at your current portfolio, take a look at your holdings, and please, before you buy stocks in an industry in which you are already concentrated, make sure that you are fully diversified on the other asset classes. I'll talk about diversification and portfolio rebalancing very soon, as well as asset allocation. Besides size, sector, you also have to think about style. So do you want to buy a growth stock or a value stock? So growth investors might look for companies that are expanding rapidly. Oftentimes, these are companies that receive extensive media coverage and get labeled as quote-unquote disruptors. Meanwhile, value investors might look for companies they consider underpriced. So both investment styles have their benefits and risks, which is why many investors own a mix of value and growth stocks. What about dividends? So you want to figure out whether the company you are about to buy pays dividends. Because remember, there are two ways you can make money if you own a stock. You can make money if the stock's price goes up. In other words, you have an unrealized profit. It is unrealized because you haven't sold the stock yet. And the other way is when the company pays out dividends. Now, dividends are paid yearly or quarterly or every 6 months, depends on the company's board of directors and the liquidity level of the company. So if your goal is to increase your ROI over time, I would strongly suggest that you buy a dividend paying company. Now, all companies do not pay dividends. As a matter of fact, companies that pay dividends are not even required to pay dividends. They might pay dividends today and they might say, next year we're not paying dividends. There are a lot of elements that go into a dividend paying decision making process. Maybe the company wants to use the money for other investments. They want to expand. They want to go global. They want to acquire new customers. They want to acquire another company. So if there are no investment opportunities out there, the company might decide to give the money back to shareholders in the form of dividend payments. So you want to pay attention to that. Now, if you're lucky enough to own a dividend payer as a stock, in other words, a company that pays dividend, you want to enroll in something called a DRIP. A DRIP is a dividends reinvestment plan, a DRIP, and the scheme allows you, and you can actually sign up on that. You can sign up on your brokerage firm's platform. And basically what it is that whenever the company whose shares you own distributes dividends, the money doesn't go to your bank account. It is reinvested, right? And that's pretty cool. Of course, you still have to pay taxes on that dividend income though, but the money grows with the magic of compound interest. You also have to think about whether you want to go solo, you want to buy one stock, the stock of one company, or you want to buy a mutual fund. So you can buy, when it comes to mutual funds, you have exchange traded funds, you have mutual funds, and you also have other types of funds. You have index funds. So what I'm trying to say here is you want to think about whether you want to buy one particular stock or you want to diversify, in which case I would suggest you buy an ETF or a mutual fund. I'll be right back right after this. Don't go anywhere. Welcome back, folks, to another edition of Sweetie Kiwi. We're also having a conversation around how to properly analyze a stock. So I've been talking to you about, in the first two sections, I talked to you about having a plan. You need to have a plan that matches your long-term investment goals and financial situation, aspiration. You need to know the key criteria. So I gave you size, sector, style, dividend paying, and individual issue or fund. Now you need to evaluate the company's financial ratios. There are several ways to evaluate that. You need to know whether the company is growing. So how do you do that? You check its revenue. There is a financial statement called income statement, also called P&L, profit and loss statement. On that statement, on that report, you can see the revenue. So revenue is the total amount of money a company generates from sales of goods and services. If it goes up from one year to the next, that's generally a sign of growth. An even better sign can be increase in net income, which is a company's total income minus its expenses. Now, how much is the company earning? You want to measure something called the earnings per share, the EPS. EPS is the company's earnings divided by the total number of shares it has on the market. This is outstanding shares. So a high EPS generally is kind of cool, right? Or an EPS that is trending up. It's a great sign that the stock is healthy and the potential opportunities for investors. Be wary though. EPS can also jump for less. They can jump for less, several reasons, such as a reverse stock split. Another question you need to ask yourself is the stock fairly priced? So you can examine its PE ratio and the PS ratio. So the price to earnings ratio will tell you what investors are paying for the stock in relation to a company's earning. This metric is often described as how much you, as an investor in that company, are paying for $1 of earnings. Meanwhile, the price to sales ratio, PS, compares a company's stock price to its revenue, aka sales. The P ratio is the stock's current price divided by earnings per share. For example, a P ratio of 20 to 25 means investors will pay $20 to $25 for every $1 of earnings. A high PE ratio usually means investors expect higher earnings, but it can also be a sign the stock is overpriced. So a low PE may indicate that a stock is underpriced lower, or it might be an accurate reflection of a company with limited prospects as of the right now. Now, meanwhile, let's talk about the PS. The PS ratio, aka the sales multiple or revenue multiple, can be found by dividing the company's market capitalization by its revenue or total sales over a specific period like a year or a quarter or 6 months. You can also calculate the PS ratio by dividing a company's share price, right, by the company's sales per share. So comparing the PS ratios for companies in the same industry is kind of cool because it can help you get a sense of which ones might be undervalued or overvalued. Let's talk about some of the red flags. You want to watch the debt to equity ratio. Some debt is normal, but if a company is loaded up on debt, this may be a warning sign, and you just want to stay away from it. So you have a ratio called the debt to equity ratio. This can help you compare stocks. It is measured by taking a company's total liabilities or debt and dividing it by shareholder value. So a DE ratio of 1 or lower generally suggests that a company can cover debts if it has a bad year. A high DE ratio, however, may be a sign the company is in over its head. All of these ratios and metrics can be useful, but I want you to keep in mind that relying on any single metric in isolation can lead to poor analysis or investment decisions. And that's very important because picking a stock, properly analyzing a stock, you have to look at a variety of metrics. Also, be wary that companies can perform well in the short term according to certain metrics, but don't always sustain that performance over time. Investment can look better than they really are. It really depends on, and again, we are talking about a stock market and a global economy that is constantly changing, that's constantly shifting. Now, one area you also want to pay attention to is volatility. How volatile is the stock? Before picking any stock, please make sure that you get a sense of how volatile it tends to be in order to give yourself a better chance of knowing what you're signing up for. A metric called beta. A lot of analysts use that. We have a show currently in the works that will talk about advanced trading, and we'll cover beta a lot in that show. And beta is basically a numerical rating of a stock's volatility. So beta compares the fluctuations of a stock to the broader moves of the market, indicating how sensitive that stock is to market movement. So the more volatile a stock or other traded investment is, the higher its beta tends to be. And the less volatile, the lower the beta tends to be. So while investments with lower betas are generally considered to be less risky, lower betas can also signal less opportunities for reward. What I'm trying to say here is that once you have to constantly think about your long-term investment plans, right? If the beta is too low, that means the volatility is low. That means this is a stock that if one day the overall market moves by 10%, that stock might be moving by maybe 2% or 1%. Is that really good for you or bad? It really depends upon your life situation, where you are currently in life, whether you're young or you're in your 50s, nearing retirement, whether you want to espouse an aggressive strategy versus a conservative strategy when it comes to portfolio management. All of those things have to be taken into context. So let's talk about whether or not the stock you're about to buy is a good deal. How do you figure that out? How do you determine if it's a good deal? Well, you want to look at return on equity, ROE. So everyone wants to know if they're snagging a deal or getting gypped. So return on equity is a measure of how well a company is turning equity into a profit. And this can help you because it's all like you're basically measuring the kind of bang you are getting for your buck. The return on equity ratio is net income divided by shareholders' equity. It tells you how much bottom line profit a company earns per dollar of value that the shareholders have invested in the company. So when you evaluate a company's ROE, it is important to compare it to similar companies, that is, companies in the same industry and of comparable size. It can also be helpful to compare a company's most recent ROE to its ROE in previous years to see one thing. And is profitability improving or getting worse? Another metric you want to pay attention to is how does the stock compare to the competition? Well, the best way to do this is to explore analyst research. There's a lot of analyst information out there, some of it free, some of it paid. But if you go on sites such as Yahoo Finance or Bloomberg.com or MarketWatch, to name a few, you can get pretty high quality analyst research that is available, that's free. So analyst reports can help add quantitative as well as qualitative information to your research, such as evaluating a company's competitive strengths and weaknesses, new products, and important consumer trends. Because analysts also regularly look at management, including stability, track record, and the cost of operating the business. So if you're invested in an ETF or a mutual fund, you may choose to do some of the same research on the fund's biggest investments, and this is known as holdings. You can also compare the fund to an index of stocks with similar holdings, known as a benchmark. So the S&P index, S&P 500 index, for example, is a benchmark for large cap stocks. Remember, the large cap meaning companies that have a market cap above 10 billion. So if you are investing in an actively managed mutual fund, the long-term performance and track record of the fund manager can help you evaluate the fund's success over time. So you should also pay attention to the fees associated with investing in a fund. An expense ratio is one measurement of the cost associated with investing in a fund. So this cost include, for example, payments to the fund manager. That's important to know. Transaction fees, taxes, and other administrative costs. And those are at the end of every year, they are deducted from your returns in the fund as a percentage of your overall investment. I'll be right back right after this. Don't go anywhere. Welcome back, folks, to another edition of Sweetie Kiwi. If you love the content's clarity and quality so far, please consider subscribing to our channel and turn on the notification bell so you are informed in real time whenever we release a new show. And we release this kind of shows every single day, rain or shine. Thank you so much for sticking around. I'm going to finish here by saying you want to monitor the stock. One great way to evaluate a stock is to watch and follow it for a period of time before becoming an investor. Don't rush. If you're a long-term investor or a short-term investor for that matter, you can afford to wait 1 or 2 months before getting in, because data on past performance can help provide some context around the stock's behavior. But putting yourself in the shareholder's seat can sometimes give you a better feel for how you might handle what will be a bumpy ride. So even when taking care to incorporate this and other considerations, you may find yourself with investment losses. That's what it is. You cannot invest and always think about being profitable. So keep in mind that diversification, very important, asset allocation and research does not prevent you from losing money. Another thing I want to mention here is that you have to also be ready to understand that markets go up and down. That's what markets do. If you're having a sell-off, that doesn't mean that you have to sell the stock also, because remember, there is a reason why you picked the stock in the first place. And if the reason is based on diversification, asset allocation, and research, solid research, it doesn't matter if you're having a temporary bump on the road or a temporary dip in the markets, you should still stick around. So this is what I just wanted to mention, and this is very important. All right, let's quickly recap today's conversation. So I talked to you about going in with a plan, knowing the key criteria such as size, sector, style, dividends, individual issue or fund. You need to evaluate the company's financial ratios. So you want to check its revenue. You want to measure its EPS, the PE ratios, the PS ratio. You want to look at debt to equity ratio, how volatile the company is, the stock is rather, and you want to figure out whether it's a good deal. And you can look at the ROE, the return on equity. And you also want to see how the company compares to the competition. And last but not the least, you want to monitor the stock for a while before jumping in. I will see you next time. I wish you the best of luck. And until then, remember, stay marvelous.